sit up a little.
Sit up a little? Sure.
Yeah.
There we go.
Right there.
Nader's so goddamn bossy. Welcome to The Future's Edge. I'm Jim Urio, and our guest on the first Friday of every month is Mike Arnold. We also have Bobby's out today for some personal family reasons. Our thoughts are with him, but we're still going to bash the shit out of him when he's gone because it's kind of what we do. We want to stay in character. We also have Nader, who's our executive producer. He's very, very smart. Nader, say hi to the people, will you?
Hello, hello.
Okay, good. That's all we want to hear from you. Just kidding. You can pop in whenever you want. But we have Mike Arnold. Now, Mike Arnold is, I think, one of the best technical analysts in the business. And I say this honestly. And the most interesting thing about this is that I've been speaking to him for about a year. Prior to talking with Mike Arnold, I thought I knew everything I needed to know about technical analysis, and his stuff is better than mine, and it causes doubt. So I'm like, it's like you got to be on one side of the road or the other side of the road. So the moral of this story is I got to pick a side, and I'm going with Mike Arnold. Mike, glad to have you as always.
Glad to be here. It's just you and me, Jimmy, in these challenging market conditions.
Challenging market conditions, unprecedented times, which it is pretty weird. And before we get into, this is the stocks you have up for the S&Ps, right?
Yeah, those are the S&Ps.
So before we have Mike on, we talk a little bit about fundamentals. And Mike likes to talk about fundamentals. It's just not his thing as much as it is Bobby and I. But one thing that dawned on me in the press conference yesterday, in the FOMC yesterday, we're filming this on Thursday afternoon, is that he came out with his statement and it said that they had to consider the cumulative effect of rate cuts. It had to consider a lag time of rate cuts. The stock market started to treat that as good news and started to rally. Half hour later, he takes the stand. I personally believe that he knows the stock market is rallying. And he's like, you idiots misinterpreted me again. And he came after us with a hammer and knocked us down. Until yesterday, I believed that the Fed didn't care if the stock market broke. Now I've taken that one step further. I genuinely believe they don't want the stock market to rally at all because they believe they need all tools to be fighting inflation, including not having any sort of wealth effect come from the appreciation of assets. Michael, did you hear that too?
Yeah, and I completely agree with that. 100%. I've never been on. First off, any slowdown is not a pivot. I just want to get that out there. I say this on YouTube all the time.
You're on Bobby's side. Great, thanks. I'm wrong. You're right. Go.
No, because I gave the analogy yesterday on my live stream. Let's say I'm going for the Fed's been at run pace, all right? They went out for their jog. They ramped it up. We've had 75, 75, 75, 75 now, right? 475s. Yep. They're at run pace. If they're slowing the pace, they're going, all right, from all out run to jog. So that could be a 50. Maybe then they go to a 25, which is, all right, I'm going to a brisk walk, slow jog. Yeah. Any pause would be them stopping with their hand, huffing and puffing with their hands on their hips. Oh, well, what a run that was. A pivot would be turning around and going home.
I like it. All
right.
To put an underscore on what you said, Nick Timiraos, who's supposed to be the Fed's mouthpiece from the Wall Street Journal, which it underscores how stupid and comical a system we're in, where the Fed leaks out information through their selected journalists. But if he's the selected journalist, fine. And he came out and his metaphor was the Fed has been flying in the carpool lanes. Now they've come out to the regular freeway so as to not miss their exit when they pass. Did you like that metaphor? That's kind of what you said too, right?
Yeah, that's good. And they might be in the middle of the three lanes right now, and they're going to slow down to the right-hand lane as they're going to look for their exit. That's great. There's nothing about a slowdown. Remember when 75 was considered like, oh my gosh, are they really considering 75? And then it's like 75, and everybody's like, now 50s. Oh, how dovish is 50? A long time ago, last spring was, can you even imagine them doing 75? And now it's like 50s, like dovish.
I agree. You get numb to these things and it's crazy. So I was on every television station for the last 3 weeks saying, if I got a settlement above 38.25, a weekly settlement in the S&Ps, and then follow through on the next week, I would think that the bear market was over. It's important that we didn't get follow through. Like I've been pilloried and vilified on Twitter, which I don't care. I'm wrong enough, and I'm not trying to say, well, gosh, I wasn't wrong. But realistically, I wasn't wrong. The confirmation has to be part of it from a technical standpoint, right, Mike?
Yeah. And again, we have a concept. When I say we, I mean Bob Icino and myself, where you can have a pattern, and I've done a ton of research on this, a pattern confirm and not trigger. Meaning we could have something happen and say, all right, this is in place, but we're still waiting for a trigger, which means in a trigger, generally you apply the trade. So
right.
in my speak, your thing would be, all right, we close above this level is a confirming. However, the trigger is if we get the follow through.
Right. Okay, good.
So that's how I view it.
Right. I made money on this because I didn't. And I said, I'm not loading even if I did get my trigger and think the bear market was over and we're heading higher, that doesn't mean I'm putting all my net worth on one spot. We always live to fight another day. And technical analysis, as we both know, is a really good framework and blueprint, but it is far from flawless, correct?
Well, but there's nothing that's 100%. It's why I trade the probabilities, and I'll talk to this really quick. Every pattern that I trade has a probability across multiple markets and timeframes associated with it. So if there's a 70% probability of this pattern going to completion, there's also a 30% that it won't. Now, I don't view it as I was wrong. I mean, the trade was a loser. Yes, I will say that, hey, the trade was loser. I put it on, it was a loser, but it was one of those 30% based off of whatever pattern it was that didn't work. So you go in that knowing that. I have not, in 30 years of doing this, and I've tested thousands of systems at this point. A lot of them have been automated tests. I have not found anything that's really has proper reward to risk that is like close to 100%. It doesn't exist.
Yeah, right. Of course not. And good. I'm glad we got that out there. And again, for those people on Twitter, I have no problem with being wrong. Some of the best traders I know are wrong, 55% of the time. And those 45% that they're right, they kick ass on. Now, technical traders, I hope they have a little better hit rate than that. But let's move along to it. And what each time we do these, and the viewership for our podcast has been flying and growing. So each time I assume there's some new people on. So I like Mike to explain his process and kind of rip it down to the studs and build it back up in about a short 5-minute thing. Is that okay with you, Mike? And can you do that?
All right. Process, we use key levels. We use what I call harmonics, which are essentially 8 increments of dividing key rallies and pullbacks into 8 increments, and a concept to keep me roughly on the right side of the market called a rotation zone. Up on my chart, the rotation zone would be the orange/yellow line and the blue line. And as you've seen, and this is a weekly chart right up there in the S&P, as you've seen the last 2 weeks, we rallied straight to the rotation zone.
Oh, Mike, real quick. So the rotation zones are 2 different moving averages. Can you tell people what the moving averages are?
Sure. It's the 8 exponential moving average and the 21 exponential moving average.
So the reason you didn't say 8 days is because you're not on a daily chart. You're on a weekly chart. So it's just the 8 exponential. And the 21 exponential?
The 21 exponential.
And then the 200 simple. Is that correct?
I have one other in there. The 200 simple is the red line, which is key long-term support resistance, and it's generally become a self-fulfilling prophecy. The other one is the green line right here, which is the 50-day exponential. So also I've done a fair amount of testing for the shorter term moving averages. The exponentials test out with higher probabilities than just the simple. So we use the 50 exponential, and that is a key level for using targets, for raising stops, for watching for market reactions.
Fantastic. Okay, good. And what charting system is this, by the way?
Oh, I'm on TradingView.
TradingView. Okay, good. I like it quite a bit. It's very, very cool. Okay, so we're in a weekly of the S&P. The reason we're so broad is because we've had some big, huge movements. So we need to see what's changed. I have a feeling that Mike's going to say nothing's changed and we're still moving lower, or that's where the probability is. Can you explain?
The long-term probabilities are still lower. But right now we had the little run up, and just overall macro from simple technical analysis, we're still making lower highs and lower lows. Even if we get a continued rally, we have not broken, at least in the S&P, we have not broken a critical level that would lead to a retest of the lows just yet. However, if you look at the chart, we're still in lower highs and lower lows. And why I'm on roughly the once a month, and right now we have a lot of stuff coming up. Tomorrow, it's Thursday afternoon, we have non-farm payrolls tomorrow. We have election next week. We have CPI numbers coming out. Then we go into Thanksgiving period, which Thanksgiving weeks normally has a slight bullish bias, and you can get some pretty substantial rallies. So I'm sitting here with a more macro focus for this month, and I already know my key levels that I can outline on this podcast of what exactly I'm watching for, and whether that shifts. Long-term, I'm bearish. Whether it continues short-term to tip back to bullish, I have a level, or whether to continue into more bearish mode, I have two levels.
Let's roll.
All right. Bullish mode would be it could start being done on a daily basis, but the confirmation is a weekly basis, just as Jim said, follow through on a weekly basis. I like confirmation, and confirmation is a weekly close. The close is the most important part of any bar, daily, weekly, etc. A weekly close above about 39.15 takes us above the weekly rotation zone. The target, not only from harmonics, but from a shorter term channeling standpoint, we have an intermediate target, which I use for stop reduction, right in front of 4,000. It's roughly 39.87, 39.88. The next target area, which would be for profit taking and or continued stop reduction, is right around 4,050 to 4,040. That's the decline of the weekly 50 period and a harmonic projection level and a pattern that's still unfolding that has not been stopped out yet. And if I zoom out even more, we have a declining best fit channel line right above there.
Right. So tell me this. So when I kept saying a weekly close above, I said 38.25, and we had the weekly close above it, and then I wanted to follow through. Basically, you're saying a similar thing to what I'm saying, correct? You're just putting finer points on it.
Correct. So
Yeah,
if I got the weekly close above those first levels I listed, 39.15, then I'd be a short term, I'd continue in a bullish stance. And, especially as we got these upper targets, and timing's rough, but it could be, because it depends how we get there. But it would roughly take us, if it happened in the next week or so, to the beginning of December, just after Thanksgiving, and then I'd be starting to watch for the next rollover play. To the downside, 36.61.75 on a daily close takes me into the probability shift for a retest of the beginning of October lows, and those low areas.
Because that's such an important thing. Can you say it one more time? The level.
A daily close below 36.61.75.
Okay.
Takes us to a retest of the October lows. The probability shift that way, which would actually take us back below the 200 week. Now that retest area would be 35.55 to the low of the week of October 10th, which is 35.02. So we could retest that and have a snapback. bounce again. However, if we get a close below the 200 SMA, and the 200 SMA, people think it's a hard wall, though it's an area. So I like to refine that area, and the closing, if we did retest those lows on a weekly closing basis, if we got below 35.90 weekly close, that is not good. Very, very bad for bullish, even in the short term. We then would be targeting, and this is where these channel lines help come into play. The harmonic targets would be 3,400. It just so happens I did not pick a round number. It's where a key level and the harmonics came out. That would be an intermediate dropping level, and a major cluster level on a significant sell-off would be 3,340 to 3,300. And that could happen if this, and the channel lines would be an area to watch for support, and that would take us pretty much potentially through mid to end December. Then that's only if we get that weekly close below 35.90.
Okay, that's interesting. So do you think, is that all you want to say on the S&P? Should we move along, or is there anything else interesting for you?
No, I want to cover something between the S&P, NASDAQ, and Dow, though, with some macro sort of focus. So those are all the key levels on the S&P I'm looking for.
Okay, good. So let's move to what you want to do next. Your call this time. Dealer's choice.
Let's just go through the NASDAQ, because the NASDAQ's been the weakest. And in some ways, I want your opinion on this, because I've been around, not only I think it's just the most challenging market. I was around, the financial crisis, 2008, 2009, .com, I've been going since 92. So my opinion is this is the most challenging market environment I've ever been involved in. However, recently parallels have been tying in more with 2000, especially with that strong rotation, NASDAQ breaking down, tech losing leadership, the sudden shift into the Dow, with the Dow recent strength, the Dow sort of keeping sort of the hope alive. But when that Dow rolls over, we've already seen the NASDAQ breaking down. I just wanted to get your opinion, then I'll go through key levels in the NASDAQ.
So my opinion is this. I think I understand the NASDAQ breaking down. The NASDAQ and the growth stocks hate rates going higher, and we knew rates were going to go higher significantly. And oh shoot, nothing. I just got a text about something else. But anyway, those FANG stocks had built up such enormous positions that it just seems logical that if you're going to shake the tree and if you're going to knock out potential asset bubbles, you have to start with that. The Dow, to me, and I don't trade the Dow and I don't look at the Dow. And up until recently, I thought it was unimportant. Now I actually think it is more important too, because it seems like it's almost a safe haven among the equities. But if that safe haven starts to go, then yeah, I think we could be in for some serious trouble. A lot of people have said to me, well, there's no Fed put anymore in the stock market. And we started the show saying that I think the Fed actually wants the stock market to go down. But to say there's no Fed put, I think is wrong. I think there is a Fed put. It's just way lower. I think that the Fed would step, if we started seeing down 40% in the S&P, I think the Fed would step in and start to ease rates again. And the NASDAQ, I think, could go down 40% and the Fed be okay with it, just because of its immense position buildup and that it's got to readjust to rates. Does that make sense?
Yeah, I don't know where that. Again, yesterday they said, Powell said, if we overdo it, we have tools, which is loosening stuff up again. Which whether that, I don't know if there's the Fed put just solely based off the market. But if the market went down even more substantially and inflation started unraveling rapidly, yes, you could have. I think they would take some of the market more into account. Hey, it's down this substantial level. Right. I'd be more so over the 50% level, but that's just. I'm not.
Yeah, sure. Now we're just talking semantics. Exactly.
Yeah.
Right. So it's there. They want to oversee a decline. They want to oversee a breakdown of aggregate demand in the economy that handles inflation. And they want it to be orderly. And what we're both saying is the moment it starts to smack of disorder, they may panic a little bit. So we'll see what happens. So here's the NAS, and that's already almost down to the October lows, correct?
Correct. Yeah, the Nasdaq is just ugly. So in my three bears in the porridge analogies, the S&P is the just about right porridge. The Nasdaq is the cold porridge. This is the porridge that's now been sitting out way too long and should just be thrown out. And you have the Dow, which is still the over hot porridge.
Right.
So what does that mean for me? Breakdowns, where if I see the market starting to break down, I'm first looking at the NASDAQ for the short side. If I start to see rallies in these current conditions, I'm first turning to the Dow, and then I'm turning to the S&P. Out of the way. So
okay.
What are the key levels? On a closing basis, this is about 10,700 on a weekly closing basis. We've already retested the low areas from October from the key weekly open from the 17th. And that was actually pretty much tested today on this down move. You can see right here. So Let me just go through that on a weekly close. That's a big below the low of, or the open from October 17th. We're already back below the weekly 200. Now the key levels, if I'll do downside first, 96.60. If we break down 96.60 and then 89.14 to 91.51 are my key downside levels in the NASDAQ. NASDAQ also, if you just look from a macro perspective, we had this low area back from June, which we had the strong rally off of. We've bounced, and people think support and resistance is like a single line or a brick wall. It's not, it's a zone. So if I just zone this off on the chart, you can see here back into that rotation zone concept I started talking about. So we start watching for the rotations back down, and here's the support. This would be the prior support area. Now it's the prior resistance area. You see we popped back into that area with the rotation zone and rotated down. So this still favors lower prices, especially if we get that key weekly close. I always like to analyze both sides because there is a bullish case too. The bullish case on a daily would be a daily close above 11,734. It becomes solidified on that weekly close only. If we get that weekly close above there, the targets, we have what I call a harmonic cluster at 12,370. The next key target area, which is also a triple cluster, which is harmonics and a key declining moving average, which in this case is the 50-week, would come in around 12,007. And the final lowest probability would be 12,995, so roughly 13,000. So those are only if we get the first daily close above 11,734 confirmed by that weekly closing follow through, to put it in your terms.
So by the way, that's kind of corresponds to the same daily / week, the same weekly high as what the S&P had, right? So it's kind of the similar thing. It's just that the NASDAQ is further along.
Yeah, and this NASDAQ has what, and this is where it's interesting. The probabilities are slightly lower, that even with that weekly close until the rotation zone gets out of the way. But if this rotation zone gets out of the way and then we get that close, there's close to 70% probabilities that we could at least see that 12,700 area.
Okay, I like that. Okay, so did you already, where the downside, just give me that one more time, a close below where, and it's forget about it?
The close below, the close below this weekly open, it's 10,720. I'd make it 10,700 because the psychological nature of that, when I see a number right in front of that, I want to confirming.
I love that. Okay, that makes good sense to me.
So,
okay, so again, what I think the answer to the stocks is they do not look healthy, and Jerome Powell made sure that they didn't look healthy. Are we going to look at the Dow too?
Briefly, because the Dow, what I was talking about, and look at here. We just went through two other pretty substantial charts that work. I mean, the S&P is still okay. That's why I need that daily close level and the weekly close level. The Dow still looks pretty decent. I mean, here's the 200 on the weekly basis. That's all the way back down at 29,850 area, which is also key from the June lows on a closing basis. We're way above that. So you have to do some serious damage in the Dow,
right,
to really start tipping this market. That's why if we get into serious damage mode in the Dow, then I'm gonna sort of kiss the market goodbye in the short term. The first warning sign is if you get a weekly close below 30,300. That would then the probability shift, even though you got the weekly 200 right in the way, the probabilities reshift at that point for the retest of the 29,200 to roughly 29,660 area. We break below, and then this would need a key close below the beginning of October lows of 29,635. We get that. The next major target area, 27,400 to 27,250.
Got it.
To the upside, since we've already triggered a pretty key pattern to the upside that's not broken yet, we probability-wise should at least see a retest of the 33,545 area to potentially the highs of Monday the 15th. So the probabilities have not shifted in the Dow to substantially lower price action yet.
Okay, but it would be highly unusual if both the NASDAQ and the S&P started plumbing the lows and didn't drag the Dow with it at some point in time, correct?
At some point, but this is what's tying in more and more with, and I'm not saying there's a direct correlation, but this is what's reminding me of when we had the NASDAQ starting to go down after that, the beginning of the real .com bust, and the Dow was holding up, and then it gave in, and watch out below.
So tell me this though. So you look at that Dow chart and you drew that line on the upside that you said was key resistance on the upside. I can't remember what exactly the level is. But if we can close above those, it looks like either early September or late August highs, the green and the red candle. If we get a weekly close above that area, would you be willing to say, okay, it looks to me like we're heading for the all-time highs again? Because it looks like a pretty clean break at that point in time.
I will give you the exact key level that shift the probabilities. 33,758 on a weekly close.
Okay.
Now that does not mean new highs. That means retesting the high area, which would be the high area that was put in January of this year.
Okay, fantastic. So the Dow is the one thing that gives us a little bit of hope.
Yes.
Okay, what would you like to do? I would like to do gold.
Okay.
I have a trade in gold.
Gold. Ugh.
Yeah, gold.
Go ahead, Jim.
So here's what I see there is that those three, is that a weekly you got there?
Yes, this is a weekly.
So 3 different times we've tested and gone below that red line, which is 1628, does that say? And 3 different times we've rejected it. So to me, it seems like that is a line that's very clear significance. My trade is going to be a buy with a fairly tight stop below that line. I'd like a settlement above it too. But I noticed when you looked at the charts at the beginning of the year, you're like, oh, looks like death. It does look like death, right? So is it worth a long shot against those levels, or you think that that's insanity?
Right now, let me pull off these up. This other pattern did complete. Let me pull that off. Right now, I can tell you I have a little system I call %B system, because it's based off Bollinger Bands. If I got, this actually looks like it will set up for potentially tomorrow, and this is for a short-term bounce play only. It would be a close above. It would need to verify the close. It could be taken intraday on a break, but it would have to close above 1643.20 to be valid. So that would be my tight stop play. Again, it could be taken intraday. It could be even taken intraday on another pattern. But since we're not going below daily on this podcast, that's where we sit. And that would only be a potential bounce. I don't even know if I could get proper reward to risk, but it would only be a potential bounce, maybe even back to about 1667. Let me check on the weekly. Yeah, 16, maybe it could eke out 1670.
Okay. So you're going to hate my trade, but I'm going to give the trade anyway. And I am long gold. And I don't have this on the micros because I have a pretty substantial position in gold and both gold and silver in my dollar hedge portfolio, which is obviously taken on a shit ton of water this year but it was great the last couple of years, so I'm still happy with it. But a buy at 1628 in the micro gold with a target of 1700 on the upside and a stop placed at 1575. So the reason Mike talked me out of some of the bravado and confidence I had when I was considering putting this trade on. But the reason the 1575 level, I might get him to be able to agree with me that that's the appropriate stop level, because once it breaks that level, we forget about it. But if that trade, the risk per contract, if you're stopped at your level is $530, the potential profit is $720. Do you at least like my stop?
I like your stop. It could even probably be tightened up from my perspective. Yeah. I mean, the trend down, if you just look, here's one of the challenges with this. Is why I like the rotation zone. Again, back in September, pop up to the rotation zone, slam down. Into October, into the rotation zone, slam down. You keep just watching even the last 2 weeks. If you just wanted something for a target, for me, it would have to be right around this 8 EMA, which right now is 1669, 1670 area. Because until it can prove, and also this weekly 200, which is, it's an area, but that's even coming in front of 1700. That's coming in at 1693. There's so much stuff to chew through on the overhead. That's where the target gets risky to me, because there's a lot that has to happen, that has to transpire for it to get to that target.
So if I was, because this was to be part of it too, and I had written this out, that if I get a stop, a settlement near my stop level below that line, I actually think it's a better spot to be short. So it might be a time where I would whip around and shorten up. You'd actually like that trade better, correct?
Oh, yeah. I like you. We start getting a close, by the way, the 1628 level, which was projected back from the key low in July. This is where I love harmonics. And then validated 1, 2, 3 times. It's not just coming off the chart. This is based off that harmonic concept I was talking about. We start getting the weekly close below there. You're looking, your next key levels aren't back down until about 1560 to 1575. So that's my target, first target on a breakdown trade.
Okay. So that would make more sense too. And by the way, for those of you guys watching this, the podcast we do with Mike Arnold, I actually go back and watch a second time after I do it, just to make sure I can chart all the levels, get them all down. I think it's important shit. Can we do the 10-year yield contract?
You want the 10-year yield?
Yeah, is that okay?
Oh, yep. I don't have the futures up for that.
That's fine. We can just go off the yield chart, which is fine, because I have a trade in that too. And I have a fundamental reason for it as well. Is to me, it seemed like that the 10-year rallied in yield after Chairman yesterday. There's an argument to be made that it really shouldn't have. If the Chairman is really, and he even mentioned that they'd rather go too far than go too little. If he's going too far on the short end, I don't see why the long end is rallying in yield. It almost seems like if he's full on planning and putting us in recession, that could attract safe haven money, and I think yields could go lower from here. So I'm going to give you my trade, and then you tell me what you think. Is that the way you want to do it? Is that
Sure.
cool?
That's great.
Selling the November micro 10-year yield contract at 4.15 and targeting 3.85 on the downside. Are you remembering these numbers? So you can tell me if you like it all or not. And then a stop out of 4.35 on the upside. That trade, if it hits your target, it makes $300. If you get stopped at your level, you lose $200. Let's talk about that.
That can very easily work. We're up against the key resistance zone on the, and I know the 10-year futures, not the yield futures, but the 10-year futures are also possibly hitting a key area. The only thing against this is there is a little upside pattern for rates, but if we do for a rally in rates again, but if we do break below roughly, let me find the key area, about 4.05%. The support zone comes in at 3.83 to 3.88.
Okay, so my target is pretty decent, you think? So what I'm hearing from Mike is, I'll say to you guys, and you can correct me if I'm wrong or not, sometimes we use the concept of a stop-in trade, which is somewhat counterintuitive to people because you always want to think you want to sell it at a higher price. Sometimes that's not what we want to do. Sometimes we wait for things to move in our favor, and if it gets to a certain level, that triggers our stop. Sometimes that confuses people. So what you're saying is waiting to about a 405 to confirm weakness is where you would get in if you're getting in this trade?
Yep.
Okay.
Yeah, and the stop in trade, if you want to look at it from this percentage, because we have a lot of things that trigger, especially stop ins on a right near the closing basis, because the probabilities, once you break certain levels, the probabilities from all the testing I've done, the probabilities go up substantially.
Right.
So people are like, why aren't you trying to buy the low? Why would you buy it at a higher price? Well, because the probabilities have shifted based off when it was on the lows to where it is now.
Precisely.
And I want to put the probabilities in my favor. When they were on the lows, I didn't know it would be where it would be now. Otherwise, we would have different probabilities. So, also keep in mind on anything,
I have a lot of novice time with that concept. Yeah.
Right now, this is considered, there's two kind of corrections, a pullback correction and a sideways correction. This is the weekly yield chart. So like in June through July, we had a pullback action. This is just a sideways correction with the rotation zone catching up, which is why the target area is so close, because it's going to require some pretty substantial price action to start triggering a bigger pullback move in the short term.
Okay, I like it. Okay, so to close out, we probably have time for one or two more. I think the Bitcoin story, the lack of volatility is fascinating. I think the oil story is extremely fascinating coming into an election, coming into a time where we've sold off a great amount of the SPR. And the first time a representative from the White House started talking about buying back the SPR. So actually, I've just talked myself into it. Let's do crude.
All right. Crude from the macro perspective, first off, a major short trade was triggered back at the beginning of August and hit the first target. And this is a weekly pattern, which can take many, many, many weeks to unfold. We've hit that first target and we've rallied back, and we're holding the weekly rotation zone. The only thing, we've had a couple daily patterns. There's actually a trade right now which is nearly done on a daily basis from a slight little upside. But even on a close above 93.25, the only thing that invalidates the overall weekly bearish pattern is if we got a weekly close above 105.89, so you can roughly say 106. Other than that, any weekly rallies would be the target zone for any weekly rallies on a close above 93.50 roughly is 99.97, so $100, and then that 106. Anywhere between 100 and 106, I start watching for a rollover play. As I said, we've already triggered the topping pattern, so the probabilities longer term still favor much lower prices, and this could take some time into next year. But the next major key target area is roughly $70, right around that area.
Okay. And wouldn't it be funny if the White House was actually right and they start buying it all back at 60 like they said they would, which is just so comical to me that from the White House, they're like, yeah, no, we'll sell the SPR here. That's fine. We'll just buy it back at 60. Imagine, being on a trading desk and some young trader, like, what other kind of thesis inputs do you have? Just, no, I'll just buy it back at 60. They're not very sophisticated in my mind. If they're going to buy it back at 60, we may never see 60. Will we ever see 60 for the White House to buy it back?
Well, the final target, and this is a target zone, just because, you have major support at 61.72. The target's completely separate from that major support area from this topping pattern, came in at, let me just zoom in, at 62.18. And right in front of that, you have the 200 week at 65 roughly. So between 61.82 and 65, you have major support. And the probabilities still favor a retest of that area eventually.
Interesting. Okay, so but now when you look at, I know we don't love to branch into fundamentals because who cares is the right answer oftentimes. But when you see that move that the technicals are showing us in crude, that's pretty much a global recession, right? Where demand has to be destructed quite a bit to get us down to that. So it's kind of sad almost that we're saying that, but that is what we're saying, right?
Yeah, from a fundamental perspective, you'd need a substantial global macro slowdown, which would probably not be, it would be beyond a soft landing, and I don't even think it being a minor recession. It would be a more significant recessionary forces to get us down there.
Right, and basically hearing the chairman yesterday, I believe that the notion of a soft landing, I think he's abandoned himself. Doesn't it seem so?
It pretty much he's like holding on that 1% chance, maybe.
Yeah, right, exactly. Yeah. Can we look at Bitcoin real quick too before we go? And there's a couple of reasons. One, I have Bitcoin. Two, I think it's fascinating that it's just completely flatlined and is at its lowest volatility. I also think it's fascinating that it has broke its correlation with the NASDAQ. Now it's at a 0.25. Where for the last 2 years, it's basically been trading at a 0.75 with one being perfectly in unison. I think that's fascinating as well. And when we talk about Bitcoin, we get a few more of those crazy Bitcoin holder enthusiasts to come watch our podcast. So everybody wins. So let's talk Bitcoin.
Well, yeah, it did break correlation. Also, the whole miraculous tether printing that has caused major run-ups in the past, they've not been able to do that as much. So you have that sort of bullish force out of the way. So separate from that, we do have interesting patterns. It broke above this 20,350 with the next major key area being 20,850. We have not been able to get a daily close above 20,850, 20,850. The breakout pattern, I have the daily on here. This is not the weekly since we're in consolidation. We're holding at a critical level. We've come back to the bottom of the rotation zone and potentially going to trigger a double top pattern. Is that the death knoll? No, that's just a possible return to roughly 19,000 on a daily close. It just so happens to be 20,000. It's not that I'm going to that number for any magical purpose. That's the actual number. The only thing that contradicts me or goes for the bullish case now is if I get a daily close above 2850, a daily close above 20,850, my target is 22,400.
So by the way, is 20,850 that black line you've drawn in near those highs recently?
That's this one.
Right, that's what I thought. Okay, so daily close above that leads you to believe that we could have some higher prices ahead.
Yes, my major breakdown areas is on a weekly close below 18,400. You get a weekly close and a daily close will alert you to that, but the weekly close below that I'm going to kiss Bitcoin goodbye in the short term because we have targets well below 17,000.
Right. Okay. And that makes sense. And people who are watching this, you're starting to get the rhythm of this too. You see why that's such an important level. Several of the candles fizzle out there. It's a key harmonic. And that's, I get what you're saying, right?
Yeah, and right now, if you just look at let me jump to the weekly, and you can see we're in consolidation, but we popped in the rotation zone, rotated down. We're back in the rotation zone. By the way, this 22,400 target is prior key highs based off the daily, or key candle closes based off the daily, but also the top of the weekly rotation zone. So even if it jumps up to those levels, is Bitcoin clear? And we're going back to record highs? No. This is just a bounce back with a longer term at this point pattern still favoring lower price action.
So tell me this, like just anecdotally away from technical analysis, are you impressed that Bitcoin, which has had a multitude of reasons to go lower, obviously hates higher rates, obviously hates higher dollar, has still just stuck so well at those lows and keeps bouncing off it? What do you make of that non-technically?
Non-technically, there's still some buying pressure down there for the Advid Bitcoin longs. The problem
you think it's institutional? You think that just people had a notion that they were going to buy it at 19,000 between 19 and 20? I wonder that.
There was more institutional. I'm starting to see that dry up a little more. The problem now is if this does break down below these key lows, the amount of, because now you have major lows back in June, you have major lows that have been September, October. We break those major lows, and especially if the NASDAQ's breaking down too, and yes, the correlation's lessened. But if you get major selling pressure in the NASDAQ, you'll have sympathy selling, and there'll be I believe also institutions that have been long this and tried to buy bottoms. If we get major selling in the financial markets and breakdown there will be closing out Bitcoin positions from the long side to move back into the financial markets, especially to cover some losses.
Right. This is a fascinating story to me too, because they was at their lows were down 78%, and then just kind of fizzling out at the lows. It almost leads me to believe that we've seen like the real capitulation, like all the people who were like, shit, I got to throw in the towel. So I fundamentally think that the support is pretty impressive, and I believe that stability is a good thing for Bitcoin. You can't call yourself a safe haven if you're routinely having 30 to 40% swings. But on the other hand, if it keeps flatlining, liquidity might dry up because there's less incentive for market makers to be in that space if it's not moving ever. So which one of those arguments do you think is more interesting?
I mean, from the financial aspects, from a institutional financial aspect, if that starts losing, like, hey, this isn't going anywhere, let's not even bother, that can cause problems because you start unraveling again. It picked up with institutional players and looking at this, but if it flatlines, that's the worst thing. Institutions, some of them don't care bullish or bearish, right? It doesn't matter. We can trade it as long as it's moving. If it's not moving, there's nothing to do.
Right.
That's what I mean. You're going to sit and sell premium all day long in the options market. There's nothing to do.
Yeah. And that could have liquidity drive. So this is a very, very interesting thing. It's like you got your wish for some price stability, and then all of a sudden it's like, oh shit, there's too much price stability, which makes it a less interesting vehicle to trade. So yeah, I think though how this is going to play out is very interesting. And again, I've told people a million times, I own Bitcoin, I own Ethereum. I don't trade them. I've never market timed them. I don't think. Oh, I did once with Ethereum when the CME launched announced the launch of its futures contract. I did trade it from the long side there. But other than that, I just buy it. I buy it every Wednesday. I don't have a tremendous amount. I have a good amount because my thinking is that if you really need it, if the shit really hits the fan, it'll be something that I want to have. You have it too, or no?
Yeah, I still hold some cryptos. It's very light. I got major sell signals back. I'll tell you exactly the week. The exact week was November 22nd of 21. And it was like, all right, this thing's going down. What I just put up here, interesting. I don't know if you can see it with this bottom line. This is the average true range. I put up a little 12 week average true range. So roughly quarterly at this very bottom line. You can see how it ramped up. I mean, we had mass average true ranges of above 8,000. Now we're already dropping back to 2,500. So you compare those average weekly true ranges. Look, it's already cut more than in a third. That's substantial.
Right. So something's got to happen. Okay, Mike, before we go, where, and I'm almost asking this for selfish reasons, where is it easier place to find you and get like a layout from you on a more daily basis? What do you release for your people?
You know, best thing to go is just go to YouTube and search for Path Trading Partners. You can always go to pathtradingpartners.com, which does post the videos, but you want to go straight to the source, go to YouTube. I am on there twice every day, Monday through Friday, sometimes 3 times. And on the weekend, some pre-recorded information. And then I'm live every Sunday doing market prep for preparing for the next week. So this is where I've sort of given a macro perspective, but if you want to see, hey, how things change, or hey, we've closed above this key level, what are your thoughts now? That's where you tune in.
That's fantastic. And I will for sure. Okay, thanks a lot, Mike. There's nothing else you want to talk about, right?
No, we've covered everything.
We've covered it. Let's blow then. Thank you very much. Have a great night, okay?